I really think that unless there's something extraordinary, another government shut down and it's something extraordinary happens, really by the end of next month, we should start seeing much higher crypto prices. We have gone without regulation for so long, and we've fought the battle that is the kind of status quo. So if it comes, it's an accelerant. That's how I look at it.
Raoul Pal starts with a crucial clarification. Gold is not the story. Gold is simply a coincident indicator of financial conditions. What really matters is liquidity, and liquidity itself is driven by currency debasement. Why does debasement happen? Because governments are drowning in debt. They must roll that debt, service interest payments, and eventually print or inject liquidity to keep the system functioning. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Gold is coincidental to financial conditions. So really I'm using the macro framework of financial conditions leads liquidity. Financial conditions is there as the lead into the need for debasement of currency via liquidity. That's driven by the interest payments on the debt and the debt that needs to be rolled. So it's all a macro thesis that rolls down through asset classes. And it rolls down according to the business cycle where you've got some assets that lead, some lag. Gold leads currently. So it's not about gold, it's about the business cycle. Gold is just an easy way of looking at it. And in fact, if you put the charts of Bitcoin and gold with I think it's a 180-day roughly lag, they actually match up very well. But what you found is you've got this slight alligator jaws. And the alligator jaws is the impairment of the market that's only in crypto. So therefore, it's a temporary state of affairs, most likely. And you see, if the market starts performing better again, almost everybody in crypto is underweight now. Because half the market thinks the bear market's in play and the cycle's done. And if the market starts ripping from here, everybody's kind of underweight, so they'll chase it. I really think that unless there's something extraordinary, another government shut down and it's something extraordinary happens, really by the end of next month, we should start seeing much higher crypto prices. It's coming to that point now because if you think the election's in November, they have to get the ISM from 47 to like 55 or 57 in the shortest period of time. They're going to give out massive fiscal stimuluses. They're giving tax breaks, and they're giving the banks the ability to use more leverage. That should start flowing, unless something is astray here. Now, could it be something to do with the tariff thing? Possibly. There's always something that can go wrong. There's nothing is a certainty. Everything is a probability, and there's always an unknown that comes into play. Could be a positive unknown, could be a negative unknown. The flip side of that, we've got the Stability Act. Does that get put through? We don't know. I mean, last week, I had a call with some of the people in the US government, and they're like, if we don't get this through now, it's not going to go through for 6 years. And, we're not sure we can get the Democrats across the line. Next minute you hear it's close. So I don't know where we are, but if that comes through, the guys from Bitwise have talked about this. It unleashes a lot of capital because it really gives clarity on what is what. And a lot of people, particularly the banks and the asset management firms who are creating products in the space, really need to know this. Well, we don't actually know whether they're going to win it or not. So that's the thing the market's going to get scared of next. And when and what, I don't know. We've got prediction markets this time around, so it'll give us some better odds so we can understand this. But we don't know, and you've seen how close every election is, so it's going to be nail-biting. Will the markets not like that? I don't know how this plays out, because it could be by September the market goes, no, fuck this is too risky. Because if the Democrats get a reasonable amount of votes, then it could slow everything down. And that could hit the AI trade, it could hit the crypto trade, all of this. Or it gets through the election and then it suddenly rips again into year end because people think there's now clarity. And then they'll have to start slowing the economy somewhat. Now, I don't think they'll want to raise rates unless we get an inflation problem, but they'll certainly slow the liquidity down because they don't need to roll debt in year one of a cycle. It comes later. They start in year 2, 3, and 4, or 5 in this case. So we'll see. I don't know about 2027. I'd imagine it's a down year, but who knows with what's going on and how fast the world is moving. We don't really know, but we'll use the liquidity framework and assume that it'll work.
Raoul then moves into what may be the most important part of his thesis. Bitcoin is not just money. It is a network, and networks follow Metcalfe's law. This is the same framework that modeled Google, modeled Facebook, and modeled the Nasdaq since 2000. When you apply a log regression channel to Bitcoin's market cap and extend it forward, you get a staggering result.
Firstly, when you've got a network adoption model like Bitcoin, it actually works like Google and Facebook and all of these. They use Metcalfe's law as a evaluation model. And that allows you to predict network growth over time. And you just use a log regression channel, and you can map out the price of Bitcoin, because that worked perfectly for Google, Facebook. They've been in those channels. The Nasdaq has been in that channel since 2000. It's extraordinary, the power of these network adoption models. So they become pretty forecastable. Again, nothing is perfect, but if you put the Bitcoin market cap into a log regression channel and put it forwards, you get to $100 trillion by 2032, 2034, whatever. Let's call it 10 years. So what must be true for that to happen? Simply, well, stable coins can add a huge amount of activity and therefore value to the network. Scott Bessent's already said within 3 years, they think they can get that to $3 trillion. So what multiplier effect does that have on the underlying? Because it's not $3 trillion of assets just stored. There's economic activity that drives the value of the blockchain. We've then got the asset management industry coming into this space, the banks coming into this space. We're then talking about tokenizing equities. We're talking about tokenizing fixed income. We're talking about tokenizing futures markets. We're talking about tokenizing all of these real world asset big markets. I'm not talking about real estate and stuff like that. I'm talking about high velocity, massive use case markets. So if that's the case, well, those markets are all, think of it this way, the DTCC, who are going to blockchain over time, clear about, a few quadrillion, like 2, 3, 4 quadrillion every year of assets. That's a lot of economic activity. And if you put that kind of activity on chain, it's a lot more than having meme coins. And that drove a lot of value in itself to Solana. So you just got to think of the magnitude of the finance industry. But it's not just the finance industry, because we're going to have digital ID in this AI world. So that's a lot of billions of people who need digital ID, of which it's likely to go on chain. What else are we going to do? A lot of our data will go on chain. Marketplaces of data. How do we sell data? The whole ethos of Web3, read, write, and own, that's not even happened yet. But we'll have that where things like the music industry starts reorganizing itself around blockchains. Social media organizes itself around blockchains and sources of truth. In an AI world, a source of truth is very important. So you can suddenly see that it's actually the future of the internet as opposed to us lot punting meme coins. And that gets you to $100 trillion easily. So my very first thesis on Bitcoin was that the gold element of Bitcoin itself had value. But then I said the blockchain, I think I wrote this in 2013 or 2014, but blockchain itself becomes the mechanism by which all assets will move and be stored. And I got there because after Lehman Brothers, nobody knew who owned what collateral, because there was like 32 claims on each piece of collateral. When the European banking crisis came, we almost lost everything again because the sovereigns were going to go bust. And then you realize that nobody knows who owns the collateral. We had the Cyprus bank bailout, and you realize you don't even own your own money because they took all the money in the bank accounts. Everything over 100,000 euros got taken. So you realize nobody owns anything. And I realized that blockchain was the answer to all of this. So what we're seeing now is what feels like the anti-rebellion. It's like Wall Street is adopting our technology, but we're actually winning because at the core of it still is the ethos that we can own it ourselves, we can store it ourselves, we can move it ourselves. And they've now seen what we've seen. And I always said we're going to front run the institutions, and we've done that. So it might not feel cyberpunk anymore, but there's still plenty of things that can. Privacy. If you want to have a fight against the institutions and the powers that be, that's the other one, right? Zcash, that's a big fight to come. So we've got that. So we are changing the world. And it wasn't going to be just a bunch of us owning Bitcoin and trading with each other. It was going to be blockchain rails becoming the rails for everything on the internet of storing value, moving value, and a source of immutable truth. If you win truth and ownership, you've won the battle, because we didn't have ownership and now we've got ownership. Sure, if you want to put it into a ETF, great. And people say, well, they've taken our product and financialized it. Yes, but it's also meant that Bitcoin has now been accepted as not only a store of value, but collateral as well. So therefore, we've actually, through the back door, through the Trojan horse of them thinking they're absolving our thing, we've actually won the war. We have gone without regulation for so long, and we've fought the battle that is the kind of status quo. So if it comes, it's an accelerant. That's how I look at it. Global liquidity explains 90% of the moves in Bitcoin. So let's talk about liquidity. Last year was a year where everyone was, including myself, was expecting more liquidity. It tends to come in seasonal phases. Liquidity is generally being used to debase the currency to pay for the debts, and particularly the rolling of this massive debt load. That had been a 4-year cycle. And then last year it started, we didn't see the pickup in liquidity we're expecting. And that led me to try and understand what was going on, why it had changed versus my forecast. And I realized that the debts had been extended by another year. So therefore the cycle was probably a 5-year cycle. Okay, so that gave us an understanding. We should have still had a good end to the year. Normally, Q4 is good in crypto, or at least November, December is. And it wasn't. It was the opposite happened. And that was based on, again, liquidity, because we had the government shutdown. And the government shutdown, well, it first started in July, where the Federal Reserve, planning for the potential shutdown, started rebuilding what's known as the Treasury General Account. That's their checking account. When they do that, they're taking money out of the system. It used to be offset by something called the reverse repo, which they've been draining over the last 2 years. And that was empty. So you had a slightly outsized effect. Also, Chinese liquidity hadn't picked up yet. So we had this liquidity air pocket. Okay, that's pretty normal. These things happen. Then we had the shutdown. Nobody expected the longest shutdown in history. Certainly I didn't. And what you got was a decoupling of crypto, which is the furthest end of the risk curve, because it got hit by this lack of liquidity because nobody could spend any money in the government. So liquidity wasn't there. That caused October the 10th. October the 10th was a crypto-specific event where everything broke basically on Binance and a few of the Asian exchanges, and everybody got liquidated in the largest liquidation event in history, and the market has not recovered from that yet. There's a bunch of theses why it hasn't recovered yet, but it's repairing itself, which is why we've had this choppy sideways price action for a long time, while other assets have been screaming to new highs.
Finally, Raoul returns to liquidity. Last year, liquidity didn't arrive as expected. Why? Because debt cycles extended from 4 years to 5. The Treasury rebuilt its general account. The reverse repo drained, Chinese liquidity lagged, and government shutdowns froze spending. This created a liquidity air pocket. The result? October 10th, the largest crypto liquidation event in history, exchange failures and structural damage. Crypto hasn't fully healed yet, but it is repairing. That explains the long, choppy sideways action, even as other assets hit new highs.